Hey there, good afternoon, and welcome to the April 26th edition of SRT Live with me, your host, Sean Richard. And home price appreciation is going off the charts. And we also want to know what Beijing shutdown would mean for the economy here in the US and inflation. So let's dive into the economic information that shapes our real estate market. So thanks so much for joining me. Let's dive into the news of the day. We received some home appreciation data from the FHFA, which is the Federal Housing Finance Agency, as well as Case-Shiller, which is considered the gold standard of home price appreciation. And it was blockbuster numbers. So FHFA came in at a whopping 2.1% increase month over month in home prices. One of the highest, if not the highest numbers that we've seen recently in month over month appreciation. FHFA has us at 19.4% nationwide home price appreciation year over year. So, and this is actually for February. So February of 2021 through February of 2022. Case-Shiller has us at a very, very stout 1.7% increase month over month and a whopping 20.2% year over year. So from February 21 to February 22. So let's stop and think about this for just a moment. So let's say that you are a newly minted homeowner and you bought your home in February of last year for, let's call it 300,000, maybe even 400,000. Let's use 400,000. And so from last year to this year, if you're the average appreciation, not the highest, not the lowest, the average appreciation across the country, 20.2%, that $400,000 investment is now worth $480,000. Absolutely incredible. So amazing, amazing wealth building powers that we're seeing in the housing market right now. Last week we had a relatively minimal data week. We had existing home sales, and we're going to get some more housing data this week. We also had our weekly jobless claims unemployment that came out on Thursday. Some really more post-pandemic low numbers. We had on initial claims, which is people filing for unemployment for the first time. We had our previous reading was 186,000. We dipped a tiny bit to 184,000. So we're still staying really low there. On continuing claims, so people renewing their unemployment benefits, they went from 1.475 million, dropped all the way down to 1.417 million. So almost a 60,000 decrease in unemployment renewals. So employment staying very robust, employment staying very, very low. And so, so that just, again, I've talked about it, that goes to employers hanging on to their employees. That shows that there's a lot more job openings than there are employees to fill them. We've got unemployment running pretty low at the moment. So positivity in the job market. Now, I'll make a point about this here in a minute because you've heard me talk about recession. I know that's just kind of a scary word, but I'm gonna come back to this. Let's put a pin in that. Real quick, looking ahead for this week. Tomorrow we get pending home sales, and this is important because this is signed contracts on existing homes. So this gives us a finger on the pulse of the housing market. Now, bear in mind this is for the month of March. So what we have to take with a little bit of grain of salt is this doesn't include the most recent increase in a spike in interest rates. Obviously, we've seen rates come up for the last 90 to 120 days, but we've really seen an increase over the last 30, 45 days. And so this reading that we're going to get tomorrow is going to take into account some of that, but it's not going to take into account all of that. So next month's reading for the month of April will also be a telling number that we want to keep an eye on. So that's tomorrow. Thursday, as always, we get jobless claims, unemployment claims. And then Friday, the big day this week, we get PCE, personal consumption expenditure. This is an inflationary report, And in fact, this is the Fed's favorite measure of inflation. So we need to keep an eye on that. And we're going to talk a lot more about inflation here in a minute. So let's get into what to watch in the economy as we move forward. Number one, can we break out of the downtrend in mortgage-backed securities? So let me show you what I'm talking about. I'm going to pull this up for us. And boom, there we go. All right. So I'm going to share my screen with you guys. Here we go. Mortgage-backed securities. Now, if you've watched me before, you know I get a little bit technical on this. I try to keep it simple. But essentially, for those of you watching for the first time, mortgage-backed securities or mortgage bonds drive interest rates, and they have an inverse relationship. So as mortgage-backed security pricing comes down, interest rates go up. So as you can see from this chart, we've got a lot of downward movement in mortgage-backed securities, which makes sense because rates have been rising. Now, this is the most recent quarter. If we went back and we looked at the most recent 6 months, we see that the downward decline is a little bit more pronounced. And then if we go back and look at a year, we can see we stayed relatively stable for a while, and then we kind of fell off a cliff. So let's go back to the quarterly here. So what I want to point out is we are on this downward trend here, and we have tried multiple times to break out of this downward trend. So we tried to break here. We fell back down. We tried to break above it here, fell back down, touched it, fell back down, touched it, fell back down, and we've been getting squeezed. And so here we are today. Look at this. We have broken above this downward trend. So the million-dollar question is, can we hold these levels? If we can, we've got a little bit of running room to the upside. What does that mean in layman's terms? It means interest rates could get a little bit better in the coming days. So if you happen to be a home buyer and you're working with a lender that's not keeping an eye on these things, we may be in a great position to lock your rate over the next 24 to 72 hours. So make sure that you're educating your lender. If you're a real estate agent watching this, you just need to send all of your buyers to the Sean Richard Mortgage Team, because we use all of the tools, the market research, to make sure that we're taking phenomenal care of your buyers. So anyways, send them our way. We're going to take great care of them. But this is something to watch as we move forward. So hopefully we can hold these levels. Awesome. Well, next up, I want to talk about when we could expect inflation to come down. So inflation, we all know, is the enemy of interest rates. When inflation rears its ugly head and runs high, then interest rates rise as well. So that begs the question, when are we going to see inflation come down? Now, if you're watching the media, you may hear some analysts say that, oh, well, we're probably going to see it come down as we head into summer. The Fed is increasing the Fed funds rate, which is designed to combat inflation, which is true. But I think we've got the potential to see a little bit of a delayed benefit from that. So I'm going to share one more thing for you here. And so check this out. So here is inflationary month-over-month numbers. This is the CPI report, Consumer Price Index. You can see right here, the Consumer Price Index report. And the Consumer Price Index report is an inflationary report that we get on a monthly basis that measures month-over-month and year-over-year inflation. The simple description of the report and how it's put together is it takes a 12-month rolling average. So every month, when a new metric is added or a new month-over-month report number is added, the 13-month ago drops off. So 12-month rolling average. So what does that mean? That means every time a very high inflationary number drops off, it's got the ability to bring inflation down. Every time a very low inflationary number drops off, it has the ability to bring inflation higher. So let's look at this. So we've got June of 2021 right here. Can I circle that? Oh, I can't circle that. There we go. June of 2021, we had inflation month over month at 0.9. So if we see a lower reading than 0.9 in June of 2022, then that's likely going to bring inflation year-over-year numbers down, and it's going to appear that inflation is subsiding. However, look at what we have here. Summer of 2021, we had some very low month-over-month inflationary readings. And so if inflation is still running hot to medium hot, we're likely to see month-over-month readings exceeding what we saw last year, which is going to continue to drive inflation higher. However, there is some light at the end of the tunnel because we get back to the higher inflationary readings from 2021 in October. And as you can see here, we don't dip too far, and then they get obviously really, really hot. So as we head to the fourth quarter of this year and into the first quarter of next year, there's a really good chance that we're going to start to see inflation numbers and readings come down. The Fed has been talking about hiking the Fed funds rate. We've already seen 0.25%. We're likely to see another 0.5% at the Fed's May meeting, probably another 0.5% at June, and we'll see what July 27th brings. But we're expecting the Fed to raise the Fed funds rate pretty significantly over the next 2 to 3 meetings, and that's designed to combat inflation. So if we start to see that right here, boom, this whole section right here, and going forward, we are likely going to see inflation start to subside, which will help mortgage rates as inflation comes down. So let's keep an eye out for that. Okay. Last topic of the afternoon. Let's get into it. So some of you who watch the news all the time have noticed that they're talking about a possible shutdown in Beijing, a lockdown. And if that happens, lots of bad things are going to happen. You know, a shutdown in Beijing. Beijing is definitely an epicenter for a lot of commerce, and so there's definitely a lot of potentially bad things that could come out of a shutdown in Beijing. However, I like to look at the positive side. So what positive aspects could potentially come out of a lockdown in Beijing if it does in fact happen? The answer to that question is going to be potential decrease in inflation. Like, wait a second, Sean, how is that? How does a shutdown in Beijing decrease inflation here in the US? Well, Beijing is a very high consumer of energy. And one of the major driving factors of inflation right now is increased energy costs. A lot of that has to do with the war in Ukraine. And so if we see a major consumer of energy basically drop off the grid of consumption, then that's going to bring the demand for energy down by a pretty dramatic mark. And it has the ability to trickle into global economy, which would decrease the demand for energy. And that would help energy prices and ultimately help inflation. So another global economic piece of the puzzle to keep an eye on. And so these are what we're watching this week and over the next couple of weeks. As always, I would like to say thank you so much for joining me. If you have any questions about any of the information that we've covered today, or if you're a real estate agent and you want to sit down and talk about how my team and I can help you grow your business through technology, tools, education, and just having more market presence and building your client base, then please don't hesitate to reach out. Here's my contact number right there. Don't hesitate to leave comments in the section below, and I'd be happy to answer those questions as well. But for the rest of you out there, thank you so much for joining me on this edition of SRT Live. Glad it could come to you. I am your host, Sean Richard. Have an incredible rest of your Tuesday. Take care.